Hi, and welcome back to Neon Liberalism. This week, I want to talk about a very boring subject that has suddenly become very exciting, and that is central banking. Central bankers are famously very boring people. Very, like, among the most buttoned down of the whole federal workforce, never really prone to excitement. Um, but for various reasons, they've rapidly moved to the center of this kind of roiling constitutional crisis that we're in the middle of. Um, and so, to talk a little bit about what's happening, what it means, and what are central banks, I thought I should ask on an old friend of the podcast, Maia Mindel. Maya is an economist and a writer for The Argument, among various other places, runs a Substack, Some Unpleasant Arithmetic, which is fascinating, and I strongly recommend it. Uh, yeah, Maya, thanks so much for coming back on.
Well, yeah, thank you for having me. And regarding central bankers being boring, it reminded me of a really old story about Shay Powell, where they did like a big profile on him during the pandemic, and it was really funny because one of like his hobbies mentioned was that he plays a guitar and goes cycling. Yeah, fascinating guy.
Yeah, he
Yeah,
sounds.
he apparently has a private Twitter account, so who knows? He might see this.
I was going to say, has anyone figured out what his private Twitter account is?
No, I think it's probably like Shay and a bunch of numbers, or like Shay 06 and like a blank profile picture, like a profile picture of some landscape.
Yeah, so like I said, just genuinely very boring people. Um, but to explain to our listeners what's been going on here, last week, or I guess this starts well before last week. Basically, since he's taken office, Trump has been insistent that the Federal Reserve is biased against him, that they should be cutting rates, but they're not cutting rates because they hate him, and that they're illegitimate and undemocratic. And recently, he's escalated from rhetoric to action. And he has fired or attempted to fire. Uh, these days, who can tell really whether you've been fired or just maybe fired? A member of the Federal Reserve Board of Governors, Lisa Cook. Um, it's kind of no surprise why he targeted Cook in particular. She's a black woman. And when you look at Trump's purges, they've been pretty. I mean, like for example, the purge of the Joint Chiefs of Staff was clearly they just fired everybody who wasn't a white man. So they're going after Cook for that reason. But they've kind of ginned up this specious argument. They've alleged that she committed mortgage fraud because she listed two different residences on her as primary residences on different loan applications or something. I don't really know, but it's obviously pretextual. Um, so I'm curious if you have something to add about what's going on with this particular firing, attempt
Well,
firing.
this quote unquote firing, I think the BBC had in quotes, or the Financial Times. Uh, the important thing to note about Lisa Cook is that like she was already like caught up in the right wing outrage cycle when she was first nominated, which was I think 2 or 3 years ago. She was well appointed by Joe Biden, which is already a reason for suspicion in the world of MAGA. And like when she was nominated, I don't remember the specific person's name, but he was like very quickly picked up by Chris Rufo. The allegation that she was like committing academic fraud and that many of her papers contained like faked data. One of her papers has received somewhat more legitimate criticism about like statistical techniques and whatnot, which is pretty common in economics. So that's like not especially disqualifying. People have attacked like basically every Nobel laureate this decade over the same things. So um yeah, and I mean, and there were questions about her relevant qualifications because she's mostly been an economist that deals with issues of race, gender, and innovation. And most of her papers are about that sort of thing. And so people were arguing whether she was, she had relevant qualifications in terms of her expertise. But that's obviously kind of pretextual, and the Rufo allegations never went anywhere. Nobody took them very seriously. I think the Minneapolis Fed, which was where she was doing research for at the time, directly got involved and said that like there wasn't anything to substantiate them. And this was around the same time that the president of Harvard was fired over, well, not fired, she resigned, but she was like ousted over academic fraud allegations. So she's already like a character in that world, which I think is the defining reason why she was like is like a very, well, one of the defining reasons. The other is her gender and race, but it's one of the defining reasons why she was like picked as a target. There's already a federal governor who resigned, but who's Adriana Kugler. Nobody really knows why she resigned because her term is expiring in May. So yeah, some like there's been some like hush hush discussion of her being sort of pressured to resign informally, or something that's been like talked about kind of openly on social media is that people are receiving a lot of threats and intimidation in the government, like political officials. So maybe it had to do with that, but I'm not really sure where I buy it. I think it's probably personal reasons or health reasons, which is, sure, her term was expiring anyways, and Trump was already nominated someone, Stephen Myron, the chair of economic advisors, and the guy who came up with the idea of using tariffs to devalue the dollar. So I think that like the important thing to note here is that Trump's nominations and appointments to the Fed were like it's kind of gone the same direction as he has like the general grip he has in conservative politics, because he first, well, he appointed Powell, obviously, who was appointed by Obama to the board. He appointed a few pretty standard centrist, center right economists. And he nominated two people in late 2020 that led to like a lot of discussion around Trump and the Fed. He nominated a guy called Stephen Moore, who was like a conservative columnist. He wasn't really qualified at all to be on the Fed, and he had like a really long track record of just saying extremely weird things about like Mulan. He also basically had completely hypocritical views on the economy and on interest rates. He was basically a Republican partisan. And a woman named Judy Shelton, who was like a gold standard believer and who wanted, also was kind of on board with the idea of devaluing the dollar and having a second Bretton Woods at Mar-a-Lago.
Ah, the Mar-a-Lago
Yeah, and
Accord.
the discussion at the time was that if Trump appointed someone unqualified to be the chairman of, or the chairwoman in case it was Shelton, of the board when Powell's term ended, because it was before he lost the 2020 election. Um, at the time, the discussion was whether the new chair of the Fed would control monetary policy, and it's a tradition because like the board of governors runs the Fed, but they don't like directly decide on monetary policy themselves. Interest rates are set by the Federal Open Markets Committee, which is like one of the committees of the Fed. It's the most important one. The second most important one is on regulations, basically. And the
Okay.
chairman of the Open Markets Committee is by custom the chair of the Fed. So Sharon Powell was, Janet Yellen was, Ben Bernanke was, but it's not really like required by law. And the Open Markets Committee is the board of governors, and the chair of the New York Fed. There's a bunch of like regional Feds that are very very not transparent at all. And so there's the New York, and the New York Fed is the one that's like most closely linked with Wall Street and the banking sector, because New York is the financial capital of the US, and a few and I think three rotating regional Fed chairs right now. You have Minneapolis, St. Louis, and I think, well, the other one I don't remember, but they're all like located in major cities. They conduct economic studies, economic surveys of the region. They do have different levels of prestige. For example, New York, Boston, and San Francisco are much more prestigious than the other ones. But I think that's just because those are much more desirable cities to live in than, say, Cleveland, which has its own Fed too.
Okay, so what I'm taking away from what you're saying here is that the Fed has a variety of supervisory and regulatory responsibilities for the economy, handled by their own internal structure. But what I want to come back to um, is how we keep on saying, well, maybe she was fired and maybe she wasn't, quote unquote, fired, and explain a little bit what that's about. Um, because the Fed is a creation of Congress. And the way it's been created, people are appointed to the Federal Reserve for a set period of time. And according to the law, according to the statute, anyways, they can't be removed at the president's own discretion. That's just their term of office. And this has become a pretty highly contentious legal principle. Um, the Republican theory of the so called unitary executive says that fundamentally Congress can't make laws like this, that everyone in the executive branch serves at the pleasure of the president. And this has been tested in a lot of ways recently. Um, in particular, the Trump not fired, Gwynne Wilcox, who was sitting on the National Labor Relations Board. And basically, he did this in order to deny the NLRB from having a quorum so that it couldn't make like rulings about unions. Um, but in any event, Wilcox sued and she said, you can't fire me because, again, the law created NLRB as a quasi independent agency. I don't serve at the president's discretion. A lower court said, that's right. The law is very clear. You can't fire her. She's reinstated. And the Supreme Court issued a stay, not like a final ruling on the case, but a stay of the lower court's order saying, yes, the case can keep on going, but for the moment, she's fired. And there's some fascinating reasoning in there that I want to read. Um, quote, finally, respondents Gwynne Wilcox and Kathy Harris contend that arguments in this case necessarily implicate the constitutionality of for-cause removal protections for members of the Federal Reserve's Board of Governors or other members of the Federal Open Market Committee. We disagree. The Federal Reserve is a uniquely structured quasi-private entity that follows in the distinct historical tradition of the first and second banks of the United States. And if you stop and think about it, you're just like, there's no argument there. They're like, you're just kind of blowing smoke about why the Federal Reserve is special because the court clearly is asserting, no, all the other agencies, they're not independent. The president can fire anybody, but don't touch the Federal Open Markets Committee, which I think is kind of a fascinating little turn from the Supreme Court. And I was wondering if you could try and talk about why you think that is.
Well, the superficial justification is that the Fed isn't an entirely public entity. It has banks that sort of have a participation in its decision making structure, and a bunch of private sector interests are represented not in the national Federal Reserve but at the regional banks. That's changed somewhat recently, but traditionally the presidents of the regional banks were local business owners and things like that. That's how Herman Cain was appointed head of the Kansas City Fed. Yeah, and the regional presidents are chosen by the board of governors without oversight from Congress or from elected officials, which is one of the major criticisms of the Fed. that these people who make up 3 out of 8 members of the Open Markets Committee, that's nearly a majority. Just well, actually a majority because the New York Fed, that's four. Well, nearly a majority because it's 4 out of 9, but nearly a majority of the members of the Open Markets Committee are just like elected with zero accountability. And so there is that kind of argument, and of course the history there is just probably very specious, which is not unusual for the current Supreme Court, from what I gather. But the the importance there is that the Federal Reserve is it's to the American economy, it's what the Supreme Court is to the American Constitution in a way.
Yeah, that's interesting. It's an interesting way of putting it. And this kind of brings us to some of the more historical questions I want to ask here. Because this phrase you use that they are the Supreme Court of the American economy is very striking. And you'll see it these days when people list fundamental institutions of like the overall liberal package of governance. One of the things they'll put on the list is you have to have an independent judiciary, you want a Supreme Court of some kind, you want a legislature, you want an independent central bank. Um, and that's kind of what I want to talk about here is like what that means exactly. And so I guess my first question for you is what is a central bank? Like what does that actually do for the economy?
Well, the central bank is basically they have the function of being the ones that uh, their main most like the easiest to explain function is that they're the lender of last resort. So when a bank needs money, it has someone to ask for it. And but in general, they're structured in a way that they set monetary policy. That's kind of a very generic term. What they do is they set interest rates. The interest rates they typically set are the interest for banks that banks get if they deposit funding in the central bank. So that means that they can set a very low rate and that incentivizes banks to lend more money, or they can set a very high rate and that disincentivizes them from lending because it's more profitable to keep your money with the Fed. The Fed, for example, sets what's known as a fund rate, and it's overnight. You deposit your money today, you get it back tomorrow. And currently it's 4.25%. Uh, that's annual, of course. They don't get 4% a day. That would be a lot, but yeah, that's like 1,500% a year. And it's kind of like an open question and an open debate how much central bank rates influence bank rates, because people don't borrow at the funds rate, they borrow at mortgage rates and at consumer and business rates. And the reason why that's like a pretty complicated solution, because banks also factor in the economy, they factor in regulatory issues, they factor in uh, the characteristics of the consumers that they have and the information that they have on them. So it's not really straightforward. Like, Ben Bernanke, who was chair of the Fed for 5 years, no, well, for the like between the Bush and Obama presidencies, he did a lot of really important research here, and he won a Nobel Prize for it. So it's kind of a pretty major question still how much influence central banks actually have over interest rates. But with higher interest rates, what's assumed is that there's a lower amount of credit being created, and that means that there's less inflation that because there's less money circulating in the economy, and that there's less economic activity because businesses don't can't expand, consumers can't make big purchases, so they have to cut back on other things, and that increases unemployment and decreases inflation. And the opposite is true with low interest rates. Of course, there are central banks that handle monetary policy differently. The Central Bank of Argentina, very famously, does not control interest rates. Instead, it controls the quantity of money directly, which is a whole other very technical discussion that I don't think people would be really interested here.
Yeah, fair enough. I'm not sure I could contribute much to that particular discussion. Um, but this gets to, I mean, what you're describing is what they call the dual mandate of the Fed, right? To maintain the price level, which is just another way of saying to keep inflation under control, but also to maintain unemployment at a low level. And they try to do both of these things by control of a single variable, which is this overnight funds rate that you're talking about. Is that right?
Yeah.
Okay. Um, and so I guess to kind of get a sense of why this is so important, I'm going to ask you, what's it like when economies don't have central banks?
Well, this is kind of like you have to go way back because most countries today do have central banks, even if they have like politically controlled ones, which is kind of what Trump wants. He wants a Fed that's made of loyalists to him. But if you go back to the 19th century, which is kind of the last time this happened, of course, this is a matter of disagreement among economists, particularly libertarian economists, who just don't think that this is an accurate representation of this era. But the US had sort of a free banking era. And it was a model that was implemented in a number of countries, most notably Argentina in the 1890s, well, the 1880s, and then it had a significant financial crisis in the 1890s. And what happens there is that banks individually create money, and they sort of decide based on how much they want to loan and etc. The problem is that they don't create their own money. They create money that other banks can also use. So that means that some banks can just create too much, especially if they're badly run or if they have make bad forecasts of the economy. And in that case, you can have banks uh, that don't have enough cash to support the loans that they made, and this means that you can get bank runs, which is when all of the consumers in a bank want to want to go in and get their money, basically, and that results in a and so this was sort of assumed to be related to panic because it was everyone rushing at the same time, and it felt pretty rational for them to do that if they knew it would collapse their bank. But the two economists that share the Nobel Prize with Bernanke, they say it's rational because if you don't rush into it, if you think that there could be a bank run and you don't rush in to get your money, you lose everything with a 100% probability. And if you do rush in, you get a smaller, you get some portion of your money at least. And so this means that there are multiple ways, of course, to resolve this. One of them is what's known as the FDIC, which is basically an agency in the United States government that ensures bank deposits up to $250,000. So if you have $240,000 and your bank goes bankrupt, the government will just give you your money back, and that sort of is supposed to disincentivize a banking crisis. And of course, these banking crises are very, very destructive because, first of all, they spread really rapidly. People get really worried about their bank failing. Secondly, a lot of businesses are getting credit lines. A lot of businesses are financing their expansions. A lot of people are financing their mortgages, and it creates a lot of insecurity around who actually owns those assets and whether or not it creates a lot of contractual insecurities that people. It's not that people say, "Oh, well, I get my house for free." Like eventually, you're going to have to pay for it back, and you just don't know what that looks like. So that depresses economic activity, and it's also just a very disruptive chain of events. Uh, but obviously, you could have free banking with like very well regulated banks and not have a central bank. So like the question is kind of why you also need the central bank, and that goes way back in the history of money. But people think that money came from barter as a way to solve the problem of barter. That, I have free eggs and you have a loaf of bread. We can exchange them, but then you have two loaves of black bread, or like darker bread. I didn't remember the term there. Sorry, and I don't like those as much. So I say, oh, I'll only give you two eggs, and that's sort of kind of, and that's kind of the issue there. But that's not really like an accurate version. People will just like say, "Oh yeah, well you can have the X, you owe me for them," and money was sort of created as a way to not even to like exchange it actually during the transactions. It's a way to have a clear value on how much you owe me for the eggs and what I could get and how much I could get from you in return, which is kind of like barter, but without like actually trading anything. And David Graeber has a famous book talking about debt, and that's kind of another part of it.
Yeah, I was going to say
Uh,
this sounds like systems of credit, whether or not actual coinage is being exchanged, is how like historically people resolve these problems.
yeah, it's basically to make exchanges easier, and originally it was made from things that people considered valuable. So obviously, gold. The Aztecs had exchanged certain types of cacao beans. There are other groups of people that use seashells. Well, in China, they invented paper money, but it was more similar to this type of uh, valuable money. And that kind of gets you to a very, very old debate. Like Isaac Newton was involved in this debate around whether the value of money came from the value of the material, which in this case in Europe was gold, or from sort of the power of the government behind it. Because, for example, in all throughout the medieval period and during the late Roman Empire, you would have these moments where the empire was spending all of this money, and they obviously didn't have enough coinage to, for example, pay the armies that they were assembling and using to fight. So they would take a coin that was 100% silver and reduce it to 80, 90, 10% silver and pay the soldiers with it. And obviously, this resulted in significant inflation. But so that kind of could mean that the value of money came from the value of the material, but also like this happened during times of significant state breakdown. In the French Revolution, you had a period where the revolutionary government was doing the same thing with paper money, and what happened was that this paper money was banned, backed by land. So the government was selling the land that was previously owned by the nobility and the crown. And obviously, they had sold much more land than they owned. And people were using that money normally because they kind of assumed that their government would lose the war and that the money would be worthless after the war. And then it turned out that they started winning, and everyone was like worried about inflation because then the army would come back and they like wouldn't have enough land for everyone. So that's like the perspective that money is linked to like the capacity of the government in some way. I think that's a more historically sound view. And also obviously you have the thing where we've had around 50 years of paper money and inflation has only decreased,
Yeah,
which
I mean,
shouldn't
this
really
comes
be
back to what
possible.
you were talking about in terms of free banking, right? That like, yeah, you can have an institution. I could set it up on the corner, and I could say like, yeah, you give me, you give me your cash, and I'll give you some pieces of paper that I've written some numbers on. And if people start accepting that as currency and like making trades because my word is really good and like you can totally redeem these pieces of paper I'm handing out for your valuable materials, that can create its own like medium of exchange. And like that's the system we basically had in America at one point. um of course the problem is that like I as an individual am like prone to not like to not being enough in a way to guarantee the amount of money that I'm putting out in a way, like for profit. And so, really, what you need at the end of the day is a state backstopping the currency, right? To say, like this gets back to like the lender of last resort is like, I mean, I guess countries have had like bank runs on the country, but I mean, or something to that effect. I don't know. That's an interesting question. I'll ask you, who's an economist and might know things about this. Have we
Yeah, of
had
course.
that
And
kind of problem for countries?
my understanding is that it's sort of developed from the gold standard because basically you had a mint that produced gold currency. That's where Isaac Newton worked, and that's why he was involved in this controversy between what's known as the medalists, who were in favor of metal, and the charlatists, who were like, no, this is about power. And that word, if you've heard it in a recent context, is because many modern monetary theory adherents call themselves neo-chartalists because they say that like it doesn't matter how much currency the government issues, they don't call it printing money because the government has like the power and the resources to absorb it all back. But and if you need a lender of last resort, which is what these banks got, you need like it was sort of analogous to the mint. Like the Bank of England existed mostly to solve this issue. It was like a conglomerate of all the major banks who like loaned to each other in some ways. Um, so the Bank of England is almost entirely a private bank, or
Okay,
was
so,
until like probably World War II. But
so
like in the gold standard, the problem was that it was considered like really, really inappropriate to change the parity of gold, and you could see it in the Great Depression where some countries became really, really aggressive about not breaking the parity with gold, and that cost the economies a lot of problems. They started having higher and higher interest rates in the middle of a really serious recession. Share many
yeah,
conservative countries.
yeah, because I mean, fundamentally, they could not control their own monetary policy. And I guess that's the other question I want to ask you about, because we've talked a lot about like the role of the bank as the lender of last resort, as like creating a stable currency at all in some respects. But the other thing about the pre-banking era, the era before the Federal Reserve, is that it's characterized by a really extreme business cycle, right? That there are like pretty like not just a few, but like pretty much constant boom and bust cycles on a scale that today we would regard as like an economic catastrophe happening all throughout the 19th, throughout the 1900s. Excuse me, the 19th century. Um, and so I'm curious, like, what's the role of the Federal Reserve or the central banks in dealing with that kind of issue?
Well, obviously, without like a way to coordinate between private banks, you could have a dynamic where because the main problem in banking is what's known as information asymmetry, which is that if you have a business proposal, you know about your business and your business acumen and whether or not it's a good idea more than the bank, because the bank can't like specialize in every sector of the economy for every part of the country. Of course, there were agricultural banks and industrial banks and smaller and much more local banks, but they also had a lot less capital. So that's sort of you had to. So like because you know more than the bank, that means that uh, that means that like you can sort of trick them into loaning too much. And of course, this is profitable for the bank because it generates business. You for at least some period of time you pay, and then eventually and something that's worth noting is that in this period of time the economy was a lot more agricultural. So bad weather and natural disasters had a much bigger impact on the economy. So you would have a lot of big. You would have, for example, a farm disaster, and it would spread to the agricultural bank, and the agricultural bank would start having credit issues, and they would have borrowed money from other banks that suddenly started having issues themselves. So what you will have is like a very you will have like economic shocks, especially either from international trade or from the agricultural sector, spread really quickly to a lot of the economy and cause a lot of damage really quickly. So what you wanted was for some sort of stabilizing force there, and of course that also meant that if banks suddenly started loaning too much money and the economy sort of didn't enter a recession but stumbled along a bit, you will eventually have really big bouts of inflation, which were pretty common, especially because agricultural disasters also manifest in higher food prices.
Okay. So I think there are a lot of economic problems that central banks exist to solve. And like you said, pretty much every country these days has one. They can be structured a little bit differently, yada, yada. Um, but then there's this other thing. It's not just having a central bank, but having an independent central bank. Um, and that's kind of taken to be like the gold standard of economic management these days. And I was wondering if I could ask you why. Like, what's the economic importance of central bank independence?
Well, it's actually a pretty novel concept. It's around 50 years old. The idea that central banks should be run by like these apolitical technocrats, and that's obviously reflective of a much broader shift in economics, because economists used to consider themselves very, very, politically involved because of the importance of economic policy, and started considering themselves more like scientists or engineers, that sort of thing, in the after 70s and 80s. But that's the reason why that sort of idea went out of fashion was the great inflation, right? So there was a big oil shock in 1973, and that sort of brought prices much, much higher persistently. But it really reflected uh, longer running trends. If you look at uh, broader monetary aggregates, broader inflation figures, and the difference between demand and supply, basically, and potential demand, you start monetary issues in the mid to late 60s in the United States. And also, for example, in Germany and Japan, you had big oil shocks. They didn't translate as big inflations the way that the United States had them. So it was an issue of monetary policy. And the issue there was the issue there was has been like really strongly debated. Uh, how much was due to each factor? But the first was the chairman of the Fed at the time, Arthur Burns, was sort of like he was golf buddies with Nixon. I think he was close to the Treasury Secretary. He met the president very often, and the idea at the time was that the chairman of the Fed was like the chairman of the EPA or the chairman of NASA. He was like sort of a political appointee
Yeah,
of the
he was a
president.
member of the president's cabinet.
Yeah, not the cabinet, but he was like an economic, not an economic advisor, but like an economic policy appointment that the president could like consult with. And of course this, but like the idea, but the problem is that Burns wasn't really like this super political guy. If you listen to what he said before even he became Fed chairman, he was also very ideologically opposed to tight monetary policy, because he believed it like because he believed that higher interest rates would depress investment and would like prolong inflation by making sure that the economy couldn't, by reducing supply. And that's not really an accurate idea. It hasn't really been proven true, but that was sort of a very pervasive idea. There were also a lot of other opinions about how much the economy could produce, how inflation and wages were related, how unemployment and economic growth were related, that were all very incorrect. And there were a lot of issues in empirical data as well. So this was like sort of a time where when most macroeconomic ideas were sort of being proven wrong very, very visibly, because you had big increases in inflation at the same time as you had big increases in unemployment, which wasn't really supposed to happen. Uh, and
So this is interesting because I want to press you on this a little bit because there's a kind of a standard story here, right? Where like we've been talking about, there was a time when the chairman of the Federal Reserve was, like you say, understood to be like part of the president's team and they should support the president's agenda. And Alan Blinder, in a fiscal and monetary history of the United States, he makes this argument that JFK like just very clearly consulted with the federal chairman is like, I want you to raise rates because I have these beliefs about monetary stimulus. And Nixon does this thing where basically prior to, in the run up to the election, he says, I want you to lower rates so you can to juice the economy. We'll put on price controls so the inflation doesn't hit people. This will like push my numbers up and I'll get reelected. And then we'll unwind the whole thing after the election. And they do all that. And he does get reelected. And so it's an era of like somewhat not like absolute political, but like basically political control over the central banks. And like this is regarded as bad. And it gave us, the horrible stagflation of the 70s and 80s. And we're all saved. We're saved by Volcker, who comes in kind of by accident, from what I understand. He's just like a name on a list. Nobody really knows much about him. He comes in and he's like, I'm the chairman now. I'm going to do exactly what I think is necessary. You can all go pound sand. And then what he does works. And then afterwards, inflation is under control when no one else could get it under control before. And now we have at last passed into the promised land of central bank independence, where there isn't political interference. And then the economy works better. So that's one story. But it sounds like you're telling a different story, where it's not really a story about political interference versus political non interference. It's just a story of economists being wrong about how macroeconomics works. Is that right?
yes, but I'm not going to say that there wasn't any political issues. One of the First of all, there's a paper that just came out that is really interesting. It talks about uh, how news coverage of Richard Nixon pressuring Arthur Burns sort of resulted in higher inflation. So so there is like definitely an issue where the Federal Reserve isn't not being independent is an issue, and you also see that countries that have less independent central banks, or central banks that have more turnover in their governors, or central banks that have like the president firing the board members very often, that's sort of like very closely correlated to how much inflation they have. And the understanding there is that politicians are very short-sighted because they face elections every 2 years or 4 years or 5 years. For example, in the United States and most presidential countries, it's 2 years. In parliamentary countries, it's five. And so, that means that they would want to keep unemployment low at all times, and that will result in unnecessary loose monetary policy. You also have like, of course, some more sophisticated arguments about how because political control tends to change sides once every 10 years or so. Like right now it seems that political cycles are a lot shorter, but that means that you will have very, very big changes in monetary policy in a very short period of time, which is not very ideal for economic stability. um,
So,
but like, of course, but I think that the Paul Volcker story, it's kind of true and it's kind of wrong. Like the United States has had like extremely, like very loose compared to the optimal monetary policy for around a decade at that point. So it really did take a lot of pain, to so to speak, to bring inflation down. But he was also very personally well respected, and that meant that the Reagan administration didn't want to push him around too much. In 1984, Reagan meets with Paul Volcker. He doesn't actually say this himself, like uh, Volcker talks about it in his memoir. Like James Baker, the Treasury Secretary, comes in and he asks Volcker not to raise rates in before the election because it could like cost Reagan the White House. And Volcker, like inflation was coming down, so he wasn't really planning on it. But it's sort of like that wasn't a new issue. It's sort of in the United States, at least, it's very much like because Paul Walker and then his replacement Alan Greenspan were so personally well respected, and a lot of Greenspan's reputation comes from the fact that that the economy really did really well in the 90s, and that there were a lot of calls at various points of his term for him to really aggressively tighten because unemployment was so low. And he said, well, inflation isn't going up, so we don't need to raise interest rates. And that sort of got him his reputation as the maestro. But that's sort of like that's sort of I think that central bank independence comes from also from an intellectual climate that's very like skeptical of elected governments. It's very skeptical in trade policy, which because trade policy is very easily captured by like local interests and local lobbies, and you would have like the senators from the most competitive states come up and say no, we need tariffs to protect the steel industry here in Ohio. And they're also very skeptical of active fiscal policy because of the potential for government debt to become an issue. And fundamentally what you have is like this sort of new macroeconomic consensus where you need like very stable rules around when interest rates are going to go up, when they're going to go up and go down, and that's going to reflect in inflation and unemployment being relatively stable. And that works. I mean, inflation comes down, the global economy really stabilizes, and it's sort of understood that that was a correct idea, even though like it has like a pretty bumpy origin story. But I think that like it's an idea that earned its place. It
Yeah.
earned the place it has in our economic institutions because of its merits, which are very big.
Yeah, so if I could summarize this kind of technocratic position, it's basically that the functions of the central bank that we've been talking about in terms of being a lender of last resort and setting interest rates in order to maintain employment and inflation, or to maintain the lack of inflation, whatever, um, aren't really matters of political debate, right? There's no political question about where you should set them. Everybody wants the most employment and the least inflation. Nobody wants bank runs, and you should just trust the economists to find the exact right interest rate as best as anyone can, and to do the right kind of lending. And like any political interference is like going to push us off this happy mean. Is that the position we're talking about here?
Yes, I mean the basically the position here is that because inflation and unemployment are sort of correlated, because lower employment pushes up wages and that pushes up inflation. That's sort of the traditional story. The real story is a lot more nuanced, but it's like sort of the traditional story, and it's like relatively true, at least in the long run. So so like because politicians and the public hold very incoherent positions on what they want everything in one bag and for the bag not to be heavy, as like the Simpsons put it. Because of that, there's sort of like this desire not to like give in too much to what the people want. And obviously I think that that's a valid position to take in a very sensitive matter, but it also results in an institution that's not undemocratic but very unaccountable a lot of the time.
So I mean, yeah, Joe Weisenthal, host of the Odd Lots podcast, recently made this argument that really, like, the debate we're seeing today about the Federal Reserve is about not is about who the Fed should be accountable to, the president or Congress. Because today, the Federal Reserve is democratically accountable, right? It's created by an act of Congress. Its members are, although with some exceptions, but are mostly appointed through the regular mechanisms of congressional appointment. And this is a kind of democratic accountability, but like it's also kind of like how to say uh, freezing your credit card in an ice cube so you can't get at it too easily. Right? Yeah, we're going to appoint these people ourselves, but we're going to appoint them for like 4 year terms or 6 year terms because we don't really want them to be subject to the same kind of electoral pressures because this can lead to bad monetary policy. Whereas the Trump argument is like, no, that's all bullshit, right? I want to have my hand on the lever right now. I want to lower interest rates right now because I think that's going to be good for the economy. Um, is that the kind of the situation that we're in here?
Yeah, I mean, you have two really important tensions right now in MAGA, which is first that they're sort of against like this sort of technocratic independent expertise notion. That's sort of been one of the through lines of the last decade. The moment, like the quote that best sums it up comes from Michael Gove of the UK government, and he said that like people in this country have had enough of experts telling them what to think about Brexit, and that's sort of like the mentality that this like new populist right has, and it's also like very focused on executive action, which is like why they don't like these agencies that are accountable on mostly to the legislature. But they do have like a kernel of truth uh, in their complaint against central banking. In the United States, the Federal Reserve has a lot of like a lot of their decisions are very sort of shadowy and intransparent. That and the board of governors is like not as unaccountable as the Supreme Court, but almost, because they have limited terms, and it's kind of like it's structured in a way that it's really really difficult to like influence it very much, which is of course important, but also like relies a lot on the members having like a code of honor. Multiple board of governors members have resigned due to improper stock trading in the last 5 years. And also, of course, you have the problem where uh, potentially there are 14, I think there are 14 or at least more than 10 regional bank presidents, so there's 2 to 3 times the amount of member of like Fed authorities that are not elected by appointed officials. They're elected by business leaders. And when Bernie Sanders talked about putting farmers and workers and unions in the Fed, obviously, like, I don't really remember the specific policy he was talking about. It could have been to just like have union representatives on the Open Markets Committee. But I think he also wanted farmers and unions to get involved in the regional feds where they have no authority, and they could very much conceivably have it. And there's also the fact that it's this is kind of uncomfortable, but you talked about freezing the credit card, and that's kind of how a lot of modern economic policy is handled, and a lot of like institutional designs are handled, where it's like, well, if people want to like pick up a gun and shoot themselves in the head, they can do that, but you're going to have the gun be disassembled and they have to put it together, and you have the bullets all spread apart. And that's sort of uh, how it's applied, for example, to trade policy, which has all of these like international rules and courts and systems, and it's like very arcane. But you're not really allowed to take control over trade to the extent that the United States is currently doing, because it's like understood to be bad, and it's bad for people, it's bad economics, but also it's kind of like really undemocratic to have the WTO and all of these people that you've never heard of, not even once, like tell you what you can't do as like the elected government. Because if Congress like passed the higher tariffs bill, it will also be against WTO rules. So it's kind of like this sort of, well, I mean, I'm not going to call it neoliberal because that's not like a really good term, but it's part of like that shift in thinking where a lot of the a lot of government powers and government abilities were like sort of locked beyond the control of the public, of
This
like
is the golden
elected.
handcuffs, right?
Yeah, it's like, well, Quinn Slobodian has like three separate books about this because he talks about how trade policy and trade rules and a lot of these institutions are sort of designed to financially and economically, integrate the world. Which was like has been fairly good. I mean, obviously it's had its up and downs, but it's it's integrated the world in a way that really constrains elected governments, and it's integrated the world in a way that like makes the Federal Reserve kind of the central banker of the entire world, because every country has to respond when the Fed raises or lowers rates, because that could destabilize their economies by making capital like enter or exit very very quickly. and
Yes.
and there's also like, well, Slovenian has a second book about like special investment zones and how that sort of creates a place where like normal tax law doesn't apply and normal regulations don't apply, and that's how that's like applied to entire sectors and things like that. And like the interesting one is that monetary policy is kind of part of this sort of anti-democratic neoliberalism that sort of turned into, like, evolved into the far right, because of the far right thinkers say, oh, I started reading Hoppe, I started reading Rothbard, I started reading, well, not reading, following Ron Paul, who are like very influenced by these like mid-century thinkers who thought that people could like vote themselves into totalitarianism, and you need to like restrict economic policy and to not concentrate too much power. And and goal, like a lot of these people were very pro gold standard because it sort of limits how much money the government can print. And the Great Depression, which was caused by the government, this is Milton Friedman who says it. It's not like some super left wing guy. Milton Friedman's like big contribution to economics, which is what made his name. It's like one of the most important macroeconomists ever. Is to say that like the Great Depression was caused by the Federal Reserve being too politically weak to like
Hmm.
decisively act, by a lot of very unaccountable parts of the Fed, which were the regional banks, which were the ones that set interest rates, being completely uncoordinated and being completely unresponsive to the Federal Reserve itself, and by the United States also being incapable of organizing the entire world. But the most important part is that the Fed was sort of handcuffed, had its hand ties on how to respond because of the gold standard. So all of these people are like, yeah, we need the gold standard to like stabilize the economy and sort of restrict the government even more. And sort of like a lot of the critiques of central banking, a lot of the anger at central banking is part of this general like populist anger about trade, about immigration, about all of these things. That's sort of like, there are things that we elect one person and that person can't do anything because like there's all of these bureaucrats who nobody voted for, who have like enormous power, all of these international organizations. And central banking is very internationalized because you have the IMF and the World Bank very involved in in how central banking is conducted. Like the IMF exists in large part to bail out central banks if they start failing. The Bank of International Settlements is like the central bank of central banks, and you show up to their meetings, and it's, and the first person who gets without to speak at every meeting is Sharon Powell because he's like the most important person there.
Yeah,
And
so this, I want to kind of, so I think a lot of this gets to something I talked about with the previous guest, Steve Randy Waldman, about, like you were saying, the way that international trade was kind of deliberately taken out of the hands of national governments. And in particular, the role that like international capital flows that you're talking about have like constrained the ability of democratic polities to set their own monetary policy. And this is the name for this way, a name that's been given to the system is the golden handcuffs, by I think Danny Roderick, where he say they're golden because like they produce a lot of economic growth, but you can't actually get out of them. And I guess my So Waldman was pretty critical of the golden handcuffs as a system of international trade, a system of international movement. He thinks we don't need to just go back to the way things were after Trump. We actually do need to make some changes. And so I kind of want to ask you the same question about central banking. Do we just need to go back to totally professional, totally independent central bank, or are there real problems with the way that central banks have been run and we should make some changes to the system?
Well, obviously, there's been some problems. There's been problems in every institution. And ironically, the big issue that created this whole backlash to kind of everything was the Great Recession. And the Great Recession was caused by Alan Greenspan and later Ben Bernanke. It just being very, very incorrect about monetary policy. You have like it's very dispiriting because people think of like as of the Fed as like the Jesuit order where everything is like super organized and everyone is like some high-minded theologian, and like obviously it's true these people are very smart, they have a lot of expertise, and some of them are like among them the biggest monetary experts in the world. You've got people who've written multiple textbooks that economic students in the entire planet read. But you also had a guy called I think Richard Kaplan. He was the president of the Dallas Fed, and he was talking about how bailing out Lehman Brothers would cause hyperinflation because the water bottles that they served at the board of governors meeting were getting smaller. Yeah, so you have like obviously their expertise is limited, and they're prone to making mistakes. Well, not prone, but they're capable of making mistakes, and there's like a lot of unaccountability from those mistakes, where like it's like the Federal Reserve only really acknowledged that they caused the Great Recession in like the 2000s. Ben Bernanke attended Milton Friedman's birthday party, and he said like, "Yeah, we did it. We're sorry."
And then he did it himself again a few years
Yeah, well,
later.
yeah, and there's also the fact that like that sort of brings you to the next point that it's really hard to like change the direction of the Fed. Like Ben Bernanke definitely knew that it was like a bad idea to do all of these things, but like he still had to speak for the board, and the board was made up of people appointed by George Bush, like right, and a lot of these governors who were like appointed by nobody in particular, like Kaplan and Eric Rosengreen. Well, Janet Yellen was like from the San Francisco Fed at the time, and you also have like the problem where it is like a very unaccountable institution because in some countries it's directly a private bank that the government sort of appoints its board. In other countries it's a semi-private bank, and there's like a lot of a big taboo around criticizing it in a way that makes it like feel even less politically, influenceable. And in the late 2010s, there was a lot of discussion around this because there was a lot of discussion around like race and gender and macroeconomic conditions. And that's sort of why I think Lisa Cook was elected, because she's like a person who talked about a lot about like racial differences in the labor market and how like, and she's like, I think one of the reasons she was brought in is because like there was an idea that these like very standard macroeconomists were very like very anti-inflation, and they were push and they would like push for tight money in times that it would like hurt disadvantaged people and working people and people of color the most. And so they wanted to bring in voices who had like expertise that was sort of complementary to that, and that sort of already created a pretty major backlash, right? And so there's also been a major backlash to the Federal Reserve, involving a lot more research on inequality and gender and race and diversity, which like the inequality in particular is a very important macroeconomic feature of the moment. But it's also
Absolutely.
true
So
that it doesn't reflect the political priorities of conservatives to have like 10% of research papers mention inequality.
right. So I guess my question for you is if unaccountability is a problem, are there things we could structurally, are there things we ought to structurally change about the Fed to improve accountability and improve macroeconomic management?
Well, that's a really difficult question to answer because you do really need a balance between accountability, between democratic accountability and independence, because Federal Reserve independence is a very important thing, and central bank independence is a very important thing. And like, I don't know if it came across that it's like really, really important to have an independent central bank, or otherwise your economy just melts down every 3 years. But I do think that you need like a more not politically responsive, but a more like democratically responsive board. You currently have like the seats you're appointed for like 12 years. It's pretty common for governors to just resign in the middle of their terms. And if you resign 2 years into a 12-year term, the next person will only get 10 years. And that sort of makes the appointments rotate really weirdly, and it's sort of designed to disincentivize doing the Anthony Kennedy thing of like resigning when there's a Republican president so you can get a Republican appointed. But it's also kind of you're just tying the hands of like whoever comes next, because Adriana Kugler, who resigned earlier this year, she was appointed like last year to the Fed, and she was serving a term where the previous person who served it also resigned early and also was appointed for like by like Trump. I think it was either Randall Quarles or Richard Clarida, who were both appointed by Trump. And also you have the problem where a lot of these like older, more established macroeconomists are very, very hawkish on inflation, and the last four U.S. presidents have all been very dovish on inflation, and you've still not had, and you had a dovish Fed for like 2 years in 2021 and 2022.
So you're just suggesting, we should cut down on the length of Fed governor terms.
They should like allow for more flexibility in direction, and more flexibility in like how these governors uh, sort of handle their timing. I do really think that it's a really difficult problem to solve institutionally, and a lot of it comes from the fact that I don't think that people understand monetary policy very well. I don't think people respond to it very well. Obviously, everyone has seen the poll where voters believe that higher interest rates cause higher inflation. But I think that saying, "Oh well, survey agrees with me," is a bit stupid, because surveys of business owners say that they think the minimum wage will increase unemployment, and it doesn't increase unemployment. So it's really hard. I And there's also the fact that like being democratically accountable to the legislature is one thing, and being democratically accountable to the president is another thing, because the legislature is like more representative of all groups in society. And like, there's this congressman Jamie Raskin who says that like Congress isn't a co-equal branch; it's like the superior branch. The two other branches are like inferior to Congress. So you
That's
have
something
like,
I absolutely believe, by the way.
yeah, I believe that too. That like the legislature should be able to exercise more control over administrative agencies, because otherwise you're going to get a lot of frustration built up in this period. Of course, I do think that like a lot of this frustration hasn't really been about like the institutions themselves, because you know like obviously nobody really cares about how centers for disease control are structured. People care about like the outcomes that these institutions produce, and having a Fed that is very cloistered and unresponsive, and that can't really answer to anyone for its mistakes, sort of creates the problem where if you have prolonged recessions and also bouts of inflation, you
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 undermine trust in the
reduce a lot of
institution.
like, yeah, you reduce trust and credibility. And there's been a paper at Jackson Hole which sounds like a very weird name, but it's like a place in Wyoming. They hold a big monetary policy conference there. Like the governors of all the major central banks go there. Sharon Powell gives like a big speech. He gave a big speech where he was talking about how the Fed is starting to think about cutting rates, which was like major news. And there was a paper introduced which was about like monetary policy, and what it says is that like when the Federal Reserve faces like oil prices increasing, food pricing increasing, natural disasters, it can like choose not to respond, and it can just like let it go, and that's like optimal, right? Because the Federal Reserve can't like print oil, it can't like give oil to gas stations, so that so like raising or lowering interest rates will make no difference on the price of on inflation because it's like the price of oil, and that's why they made that mistake in the 2000s. Inflation grew a lot because food and oil prices were going up because of Chinese economic growth, and the Fed sort of interpreted to mean that there were like inflationary pressures, and they raised rates from like 1% to 5% in 3 years. And the problem there was no like increase in core inflation, in like the inflation of the things that they could impact, and so this created like a very big downturn that sort of dragged down all the banks with it, because a lot of people borrowed money and then couldn't afford to pay their mortgages anymore. And like no, the Fed never really answered for that. And then there was like a decade of low growth and sort of this like cultural pathologies that come from persistently low economic growth, higher inequality, etc. And that sort of produced a backlash against the Fed. But if the Fed was like more democratically accountable, I think that they would like make fewer mistakes like that. But the paper Jackson hold the argument that it makes is that the Fed can sort of, you know, can just like know part of the situation if they have like credibility. So you do really need a credible and reliable central bank. And if you're constantly making big mistakes that nobody is made responsible for, you do end up like producing the backlash and producing the distrust that results in your institution being sort of
No,
attacked by.
I think that's exactly right. I mean, fundamentally, like you said, these are difficult issues because macroeconomics is not a simple question. If it was a simple question, people would get it right all the time, and you just have to look at history and see people getting it wrong constantly to like disastrous consequences. So you need that level of professional expertise. But I think, like you've been saying, we also do need some level of democratic accountability, and like we don't always have that in our economic institutions today. And like how to balance those two things, that's a very difficult question. So thank you so much for coming on Neon Liberalism to try and chew on some of these matters. It was a pleasure as usual.
Well, I'm glad to be invited. Like my closing statement has to be that like first of all, you cannot have a politically controlled central bank under like any circumstances. And second of all, that like the current attempt to take over the Fed isn't like a reform attempt of like fixing the issues with the regional banks. It's like Trump trying to crack down on people who disagree with him having any political power whatsoever.
No, I think that's quite right. I
Thank
To
you.
clarify for my own part, I absolutely do not think that Trump has answers to any problems. Basically, I think he just has more problems and a personal obsession with power and control that is only going to lead us to disaster.
Yeah, and I
So
mean, I do want to like pull up a more optimistic note, which is that in macroeconomics, like one of the big like testing grounds, quote unquote, for neoliberalism was Chile, because obviously I'm not going to say that that was a good thing. It was a pretty bad thing, and it didn't result in any like economic growth. But Pinochet sort of got his economic program from like a group of economists who had like a massive tome where they said like these are our ideas for reforming the economy. He sort of went with them. Obviously, he ended up departing because it wasn't very successful. In some aspects, he nationalized copper and some other industries, which like they were very opposed to this like the Chicago boys they call them. But that sort of tells you that if you come up with like ideas on how to reform the government, even if they're bad, like you need to pull out your own to pull out your own ideas about how to solve this, because like if Trump like or whomever actually breaks the Fed and actually like politically compromises it, you're going to need like a new way of doing monetary policy. So I think that like starting to think about that question, like what does monetary policy look like after like Stephen Myron and all these random Fox Business hacks and Shirley Shelton and Ivanka have all been appointed to decide interest rates, and they're 0% because Trump is in office. Like once you have to fix that, you need a solution, because the alternative is just going to be like the same thing that already exists and that people end up getting mad at. So like I think the optimistic note is that if people start like having this discussion and start talking about it, like you can actually try to find like a more balanced approach between independence and accountability, and a more balanced and macroeconomic policy that doesn't result in so much anger and disappointment at the Fed.
No, I think that's exactly right. So yeah, thanks so much for coming on, Maya. I'll see you around.
Yeah, thank you for having me. Bye.